Thank you. Thank you, everyone, for being here. It is a real honor and a pleasure to moderate this panel with so many esteemed panelists here sitting next to me. So we have a big topic to get through and not a whole lot of time. And I know certainly this is a big topic of interest for me at the moment on our show at CNBC. It's all about the China market and so much change underway there, opportunities. That's something we'll be discussing throughout this panel as well. But I just want to give you a little bit more background from each of our panelists so you can get a better idea of where they're coming from and the perspective they bring to this discussion. Next to me, first we have Jonathan Larsen, who is the Chief Innovation Officer over at Ping An Group. And Jonathan, you also oversee the $1 billion Voyager fund, which does invest in fintech, health tech opportunities globally on behalf of Ping An, of course. And Jonathan, you're also responsible for bringing those new technologies to the business in China, but internationally as well. So that's something we'll tap into your experience on too. And Zhang is with us. He is the Executive Director of CMB International. And Sean is an investment committee member of CMBI Capital in Shenzhen and has more than 10 years experience in private equity. And Sean has been involved as a key member in initiation, fundraising, and management of multiple PE funds at CMB International, which of course is a wholly owned subsidiary of China Merchants Bank. And then we have Dr. Shangzhi with us, who is chairman and founding partner of CDH Investments. CDH Investments is one of the leading alternative investment fund managers focused on China with over $17 billion of assets under management. And prior to founding CDH, Wu was the head of CICC's private equity group and also had previous roles with the International Finance Corporation and the World Bank. And last but not least, we do have Michael Dennis with us as well, who is the head of APAC Global Capital Markets at BlackRock. And there, Michael oversees both equity and debt capital markets. And with BlackRock's $6.3 trillion under management, Michael's team leads BlackRock's public and private investing and capital raising across APAC. So thank you all for taking part today. And to kick things off with this deep dive into China's market, let's just talk about the economy today and really what's happening in the way of transition. If you can just give us a better idea of the big change agents, if you will, that you see today, how they will affect the way you do business in China going ahead for the next decade. Jonathan, do you want to start?
Well, let me briefly make a couple of comments. I think, first of all, the macro story is that the consumer component of the China economy is becoming increasingly important. So we've sort of just crossed the 50% mark of consumption as a percentage of total economic output for the country. And that is the direction of travel, and that's going to be beneficial to China, and it's going to be obviously very important to the shape of the Chinese economy going forward. It reduces the dependence upon exports in particular. So that's one thing. Secondly, I think as probably everybody in this room knows, in China, in the financial industry, we have seen the most far-reaching penetration and transformation as a consequence of new technologies, beginning in the payment sector with the domination of e-wallets, in particular from Ali and from Tencent, but more broadly, fintech has had a more far-reaching effect in China than anywhere else, and our own company is an important part of that, and it's an extremely important part of what we do. And that ranges from platforms like Lufax, which is today the largest digital wealth management platform in the world, all the way through to enabling technologies. So for example, in Ping An, we have 1.4 million life insurance agents, and their entire life with us and their clients' life with us is basically facilitated through digital platforms. They never touch a piece of paper in what they do, which I think is pretty unique in the world. So they're two examples of just the scale of what's possible in China and the impact. And I think the next wave of all of this is finding applications for AI that can be transformative. I think in image technology, in what I call recursive analytics around taking a click on the internet and ending up with some kind of outcome that you want, usually a sale of a product. Those analytic platforms are now at sort of industrial scale and very reliable. I think we're making a lot of progress in natural language, conversational AI, which is beginning to replace call centers and telephone sales and activities like that. So, and what we're seeing is, I think, increasingly platforms in that space that are going to be very important. So there are a few comments on what we see.
Great, Jonathan, thank you for that. Sean?
I work in a private equity fund part, and from our perspective view, the transition, the most important part is how can we raise fund, how can we make our investments. So the difficult part here is, you see 20 years ago, there's a double-digit GDP growth rate in China. No matter which sectors we can drive a good growth. But in these days, we call it the new status quo. This may not get such a tremendous growth in GDP side. So we are looking forward to more transition from the technology part. I mean, just like Larsen mentioned, like artificial intelligence. I mean, easily speaking, it's computing power, algorithm, and big data to drive all the segments in China, especially in consumer part. We have that large populations. So that's what we are looking for in the future investments. And that's also I think it's confidential from us to ask our investor to put money in our fund, because we can find some new growth generate from that. So that's the first part. Is, I think the technology-driven traditional industries. And the second part, I think, is the demographic change. Actually, in these 30 years, I think the background is especially youth, they actually take a different kind of education. You know, like the 50s, 90s, 60s, Chinese students just can get some education from inland China. But for the late 80s, a lot of young population goes abroad, take engineering part and economics part, financial part in these kinds of years. And these talents are actually coming back to China. And we can use that kind of talents pool there, and also through the demographic change. I mean, especially in the consumer parts, we have different minds of how to consume, how much money I should pay for my amusement or something. It's quite different. So that's what I'm looking for in the future. The three part.
Another interesting point. It's not just the technology that's out there, but the changing consumer to keep in mind as well.
Yeah.
Dr. Wu, with that.
Yeah, if you're thinking about what are the important things for the next 10 years, I think the first one I would agree with previous. China is a big consumer market, if not the biggest in 10 years. In many industries, it will be the biggest market. And some of the companies, when we supported it 10 years ago, because of that size of the market, has become global in size. So their ambition also become global. I'll give you one example. Like 15 years ago, we invested in this small slaughterhouse in the middle of China. Now it become the largest pork business. It bought Smithfield a few years ago, and we helped in that transaction. If you think about China market in the pork business, is 5 times of the US. But US has a cheaper supply of hogs. So there's a globalized, the Chinese multinational in that opportunity for investing. We have done several deals in that respect. We support a Chinese company grow because the market size has become large. Now the whole supply chain restructuring, cross-selling, it makes sense for them to go next stage. So that's, I would say, that the size of the economy and the size of the company we invest. The second point I would say is relate to the innovation, is the Chinese entrepreneurship. Because of the size of the market, when you take risk, same risk, but the payoff of the success of the big market give you exceptional risk reward. And that's why this vibrant venture capital business can be justified. It's the size of the market. And it's these people wanting a better life, still working 7 days a week and trying to make more money. But that's a bit of a too much. But it's that spirit is still very much alive. I think that's very important for the technological innovation that we have seen on both business model innovation, gradually building up the internet, the mobile internet, the payment. Now they're going to put that into the upgrading the whole traditional business, retail, the whole thing is changing very rapidly. So both in terms of the technology change, as well as the entrepreneurship, it will be a very important factor for the next 10 years. The third, I think, is China has growing so fast for the next 20 years. There are imbalances. There are external imbalances, there are internal imbalances. To correct those imbalances, you create opportunities. For example, the public side, the foreign ownership participation in the Asia market is 2%. In India, it's 15. It used to be 25. So huge change can be made. On the banking side, with the deleveraging, how much NPL? How do we handle that? If you took a 10-year horizon, sometime during the process, those imbalances has to be resolved. So for the investor, looking for those opportunities would be also a big thing in the next 10 years.
Dr. Wu, I just want to ask you one follow-up before we move on to you, Michael. When you mentioned the Smithfield deal, do you think in this environment today, what we're seeing between the US and China, that could have taken place today?
Today?
Yes.
What is the most interesting?
No, do you think the Smithfield deal would have been able to take place today?
Sorry,
The Smithfield deal that you referred to.
The Smithfield deal?
Yeah.
Smithfield deal is obviously for the trade war. The Chinese put 25% on the U.S. import of the pork. So temporarily, it will affect the business. But that is not as much as a psychological impact on the stock. So on the trade war, or any analysis on pure trade, the macroeconomists have analytical outcome. Well, it's serious, but it may not be that serious. But the psychological effect of stock market and don't know the results of the negotiation have a bigger impact today. So if investor, how do you discount that? Or objectively analyzing that, or figuring out the fundamental strength behind it is a challenge for all of us. Yeah. And Smithfield, shorter term, the stock come down from 9, the WH group come down from 9 to 6 because of the trade war.
Michael, I'm sure that is something you think about too in the current psychological factors around the US-China trade tensions, but there are other things you're watching, so why don't you give us an idea?
Yeah, thank you very much. So the area that we're most focused on, and when we think about from a 5 to 10 year perspective, is really the provision of capital to private companies in China. I think if you look at both the debt markets and the equity markets, there is wholesale changes that need to happen from a reform perspective that really to provide ongoing capital in a consistent and sustainable way to corporates and to private companies in particular is going to be essential really to growth in China being stable and continuing over the long term. So if we take on the debt side to start with, we've seen that the banking regulator in China has come out and is trying to pressure as many of the banks in China as possible that 50% of their loans go to private companies, not to traditional SOEs, not to the traditional old economy companies, really trying to instigate change through reform. This reform process is the key metric that we're looking for from the Chinese government in a number of areas around the economy. There's a lot of news around the property sector as we continue to see tightening across that sector. And I think as we see the rising default rate on a number of the offshore bonds, there is further reform that needs to take place in order to really give private companies the confidence to grow. Because it's that confidence of growth, that confidence of reinvestment, the confidence of a long-term perspective that is going to be essential for China to really emerge in a much more stable and sustainable way than we've seen historically around some of the areas of growth. From an equity perspective, at BlackRock, what we're heavily focused on is the emergence of the asset management sector in China. So if you think that 65% of household wealth is currently held in bank deposits, that's a pretty staggering number when you think about that compared to in the US or Europe, and what the role that large pension funds, large asset managers, large insurance firms play in really as long-term providers of capital to companies. So reform of the financial markets, the ease of companies to list, to be able to raise money consistently and efficiently is going to be essential over the long term for the next 10 years for China to be able to continue to grow in a stable fashion. And it's those two factors around the provision of capital in the debt markets and in the equity market that we're heavily focused on over the next 5 to 10 years.
And Mike, just before we move on then, I mean, on the debt issues you talked about, how concerned are you at this stage? Do you think we've yet to see the real potential fallout from this?
I think when you've got Asian high yield having gone, or China high yield having gone from 6.9% yield to maturity in January to now 10.9 in October, it's a pretty dramatic move in spreads and in bond prices. So we think that we're going to see a dramatic fall in net financing from Chinese companies, and I think the ramifications of that potentially could be quite significant. I think if you look at the impact of property developers being able to continue to grow at significant pace at lower tier cities, I think that if they can't refinance and they can't be able to have the ability to raise capital from multiple sources, it could potentially be a reasonable drag on the overall GDP, given how significant property has been in the overall market. So there is wholesale development that needs to happen from an offshore perspective on focusing on China, so that there's a depth of funding that companies can tap into to continue their growth plans. And it's not only the property sector, but across multiple sectors.
Dr. Wu, I see you shaking your head. Would you
Yeah, I think on the public side, if you're looking at a slightly longer term perspective, there is an important fundamental trend, is the consolidation. If you look at the Chinese industrial sectors, most of them are very fragmented. So the leaders, the stronger players, should be taking more market share. Many of the company, the market leaders already listed in the public market. So in the private space, and we also have a public market affiliate, I think this is very important. When the market come down and up, right now it is actually pretty attractive relatively to the private market. But in the long run, is the consolidation play. The leaders would have already been listed. You should not, from private equity investors, should not forget about it, should continue to watch and see the consolidation, the leaders getting a better position. I think that trend would be benefiting looking at a public market of the market leaders. If most of the Chinese industry are still very fragmented, the leader take 2% market share, and that's not normal.
Interesting. I'm just going to pivot a little bit and pick up on something that both Jonathan and Sean, you really talked about it, and it's this push in innovation, AI being one of the big areas many are watching. And if we can just switch on to our topics here, because I'd like to build on this theme of made in China versus created in China. It's something we hear authorities in Beijing talk a lot about, the economic transition that is underway, and just the sheer investment that's gone into making sure that China is not just the factory of the world, but inventing the ideas. And I think AI is going to play a big role in that. I mean, this is something you work with on a daily basis. You have a view to this over at Ping An. I mean, what's your view of where we are today? How much room is there to grow, in fact?
I think there's a historical perspective here that's important. And if you think of the big Asian economies and their transitions over the last 40, 50 years, you've seen Japan. I mean, Japan was the first country where Phil Knight made Nike shoes. And he did it because you could make them cheaper there than anywhere else. And then obviously all of that business migrated to other parts of Asia, through China, eventually to Vietnam, Indonesia, Bangladesh, etc. I remember when I was a management consultant in the late 90s, my colleagues did a study for the Business Professional Association of Korea. And at that time, Korea was stuck between Japan and China. China is this low-cost labor market, and Japan is this owner of intellectual capital. And the question for Korea was, where did they go? And where they went was they stepped up and they became competitive in technology. And China's now exactly at that point where China has this opportunity to be an intellectual capital leader. And I think it is actually facilitated by some of the things that are facilitating the adoption of technology more generally. The ubiquity of mobility, mobile devices, cloud computing, and I think in the last 4 or 5 years, the conversation around AI and the capabilities that AI can deliver are completely different. Where China has the advantage is the data sets and the willingness and ability to invest, and for those companies that are in a leadership position, the willingness to take a very long-term view. So for clearly companies that the big technology leaders, that's the case. For companies like us, we have just under 500 million consumer users across our digital ecosystem. So there is no shortage of data for training, and we have a near infinite number of use cases, and we're prepared to invest with a 1-year horizon, a 5-year horizon, a 10-year horizon, and even a 20-year horizon. So I think this is going to be really interesting, and I think this has a huge bearing on China's stance in the world with regard to intellectual property. I think the natural trajectory for China is to become a much more disciplined marketplace for intellectual property. China has to do that because it's in its interest to do that, exactly in the same way that Japan did and Korea did. So that would be my perspective.
I just want to pick up on that because we talk so much about the US administration, President Trump pushing China to do more in intellectual property protection. We heard just from Premier Li down the road in Singapore today saying that they want to crack down on any intellectual property abuses, but it seems to me you're suggesting this isn't so much a push coming from abroad, it's something that's good for China's industry.
So I think there are short-term political and tactical factors around trade negotiations and around geopolitical jockeying that clearly is going on. But I think there's a macro trend here that is independent of those things, which will drive to basically the same outcome anyway.
And Sean, as a PE investor, I mean, is this something that you're focused on, see investment opportunities around?
Yeah, I think I just mentioned, and I totally agree with Larsen. Intellectual properties is a good part for long-term China. For the PE fund, we always focused on long-term growth there. So intellectual properties, maybe short-term is something bad, but long-term is good. And just back to your point about the made in China and create in China, I think. It's just depend on how do you define the create. Actually, China have created a lot of stuff, just like in the fintech side, like in the end finance. They just make the MMF to sell the MMF online. Then it's made a really popular wealth management tools for inclusive finance. I think it's creative, and both insurance side like Zhang, right? They just find some new terms, then they sell it online. It's creative, a lot of creative. I think for China, the difficult part here is actually how can we initiate or originate some hardcore technology. That actually is the difficult part. And in the maybe last 20 or 30 years, this part actually is covered by our government, by the SOEs like China Telecom or like Zhongxin or Huawei. They put a lot of money in the technology infrastructures. And now I think it's the time for other companies, right, private-owned companies, to take this kind of responsibility and also still based on the government investment, like the money put in the 5G infrastructures and all those like chips developers and all those kinds of infrastructures. Actually, government gave the high infrastructures for the SMEs. So SMEs may have more opportunities there, and we are looking forward to have more investment in that kind of side and have the infrastructure and utilize them, just like Dr. Wu mentioned, the supply chain side, retail side, to improve the efficiency. And back to Mike, I think all the financial instruments or impact is short term, or like up and downs, YTMs, always short term. the most important is efficiency, technology, whether you can improve the efficiency. I think with all these kinds, for China, the most important to make all those creations to generate efficiency. We are looking forward to that.
Thank you for that. And Dr. Wu, would you agree?
Let me say this, made in China versus created in China. I think in macroeconomic analysis sense, on the comparative advantage theory of economics, that exists. In the investment side, in the last 15 years, we never find made in China a good investment thesis. I'll give you an example to tell why. There is a Christmas tree manufacturing doing the cheapest Christmas tree at that time. 70% sell to Walmart. Where the money is going to made? In 3 years, Walmart shift all supply to Vietnam. What's that made in China? As an investor, we invest at early days all consumer brand. If you're really looking at the value chain down the line for made in China, you buy Walmart stock. I mean, that was, for investor, that export, low-end business, and no margin. For investor, there's no interest as an investment thesis. So moving that from the consumer brand, once you have a brand, you are building your own, you start having margins as investors. That's what you're looking at. Now, the innovation side, I think the first type of innovation are from the business model. Sometimes we copy from the US. Oh, there's a Google, there's a Baidu, and all of that. Then there's a domestic innovation on business. Now, because of mobile internet, because the payment made available, there are so many change in the retail, in the delivery of goods and services, and in many things that Ping An has done. Those innovations give investor better risk reward because the hardcore technology, the innovation, has a whole lot more risk. So we have to say the shifting towards innovation, towards own technology, but you have to remember the basic economic theory of comparative advantage. You don't want the state effort to say you have to do everything yourself. I will say there's a natural, progressive. The investor have to be taking long-term view. I do see the innovation in the drug development because the wave of cut returnees are doing that. I do see because of the infrastructure in 5G, in the mobile internet, in payment, we're going to change many things. The AI side, the algorithm side is fine, but you go to harder core technology, it still take a long time. So for investor, you have to see where the risk reward is, and you have to have a long-term view. I think we have to balance to see where the money going to be working for investors. So I'm saying that for us, we never think in China, made in China was an investment thesis. But recently, when we do have a big company merging the two global company, seeing where we can get the supply chain, and China has a very deep supply chain. You see that combining developed countries, combine the two companies, restructuring the whole supply chain, you have a gain. You have a business model advantage when we go to Southeast Asia, India, because we experienced mobile internet revolution first. Then we can say, hey, we can sort of seeing that what happened in the last 10 years in those countries, whether we can capture the next 5 years. Those are very supply chain, and the made in China would make sense. But don't invest in the low-end manufacturing business.
We all got that lesson, the Christmas trees. Michael, over to you.
So the way we think about it is there's a lot of news and a lot of press around, obviously, innovation that comes out of Alibaba, Tencent, Baidu, Ping An, in terms of with huge amount of resources driving the digital economy. The investment opportunities that we're looking for and the themes that we're looking for around the digitalization of the broader economy. So if you look, the digital economy is still a relatively small percentage compared to the broader economy. And where we're spending a lot of time and the companies we're trying to spend time with are those that are looking to have discussions around cloud computing, around AI, around big data, and trying to put in place strategies around bringing that to their business. And the reason I say strategies rather than actually implementing it, because actually the penetration of SaaS software, which is the cornerstone of most businesses in the US and Europe, is very low in China. ERP software, for example, and CRM, which is basic client management and basic just business management tools, are at penetration rates of 30% and 15% respectively. So we can talk as much as we want around big data and being able to use it and to use it effectively, but that's very well if you're analyzing Alibaba and Tencent and Ping An, etc. But in terms of where we look for broad portfolios of how to look what's being created in China, you want to look for companies that are institutionalizing within their own firms the idea of using technology at a ground level. So Bao Steel, for example, are a very traditional old economy company. They've partnered with Tencent on the realization that that for them themselves to make those technology advancements would be quite difficult. So they're bringing Tencent in and having conversations with them in more of just a JV discussion around how they can bring in IoT, how can they bring in big data for assessing their supply chain. And when we're doing deep dives across the different sectors within China, it's that penetration of SaaS software, which is giving us the indications of created in China could be a reality, because these companies are making wholesale changes into how they run their business from how they've traditionally been run. And I think it's those key elements that make the difference for us around being that created in China idea.
And Michael, you've also transitioned us nicely into the next topic, which is this idea of big data. I mean, you talk about the fact that perhaps other companies sitting outside the big tech titans need to find better ways to digitalize, utilize this data. Is it so difficult, though, unless you have the big backing of one of the big giants? I don't know, Jonathan, if you have any thoughts on that.
Well, I think that one of the points Michael just made is very important, which is this transition from licensed on-premise software to SaaS. And what that does is it massively reduces the barriers to access for advanced technologies, so that, as we know from a gathering like the Singapore FinTech Festival, any startup can access pretty much limitless processing and storage more or less for free. Through the SaaS revolution, we now have a set of platforms that enable AI development. Google's TensorFlow would be a really good example, or even more, let's call it application-specific capabilities. The Watson APIs from IBM, or the Facebook chatbook platform, or the there's one more I was about to think of. It doesn't really matter. But so these things are now becoming available. I was just building on Michael's point, I was in San Francisco just last week with a company that is an industrial IoT company, and what they've created is basically a generic digital management platform where basically manufacturers using any type of machinery, any type of process, can apply generic models to apply AI to improve quality, utilization, and cost, and optimize pretty much every aspect of their process. So this digitization of industry through SaaS is a really important phenomenon. And so I don't at all think it is the preserve of large companies. I think the creation of these platforms itself is going to be, some of them are going to be created by very large companies like us, like Google, like Facebook, etc. Others are actually being built by entrepreneurs. Some of them may end up as being part of bigger platforms, some of them may be standalone. But what they're really doing is creating a set of tools that can be transformative to users in both contemporary industries and traditional industries.
Interesting.
Yeah, I agree with Larsen. Actually, all the SARS or something Michael just mentioned is just, I think, the tools for how to use the big data. And actually, in each segment, we are talking about big data. It always been a question for me is, how big is big?
Yeah.
Right, in each segment. Actually, it's quite different in the to B business and to C business. Like in to C business, especially in the financial part for retail finance or inclusive finance, the big data is really important. But how do you define it? But for the company, no matter who use those big data, especially for personal data, how do you treat that is another issue, right? In the financial part, you treat it as a tools, or you treat it as an asset for your company, right? So it's actually still a lot of arguments on how to use all those big data in the 2C parts, and in 2B parts. I always asking, does it really matter so-called big data, or do we really need to use TensorFlow, to use AI to generate our business, or to make our business more efficient? So I think, in my point of view, I think it's just a tool, and it depends which industry are you in, what are you doing, and how to utilize all of them. Okay.
Very briefly, I think the opportunity for innovation there's many. If you look at the U.S., there are many 2B businesses. There's Oracle, there are IBM services. We don't really have too many of those businesses. I think there will be business opportunity in drug development, in all kinds of software, some of the technology-based business, AI business, to hardcore chips and other things that's harder. So I do think there are, if you take 10-year horizon, I think that would be an interesting area to look into, but just to be careful about the investment risk as well.
Thank you for that. And I'm conscious I do want to leave time for some questions from the audience. If you may have seen instructions up there and Pigeonhole, if you can send in your questions, we'll get to those. But first, just our final topic, which is really China Inc., the view from abroad. I mean, one big issue we talked about, many abroad looking at debt concerns. We did talk about that a little bit already, but there's also this issue, and Dr. Wu, we talked a little bit about this backstage with the Belt and Road Initiative and what that means in terms of deploying capital outside of China.
Yeah, I think there is China become a net exporter of capital, and in the next 10 years, it will be more so. And I think for us, in our practice in the last 5 years, Smithfield was a big one. Yep. We have done 4 or 5 of those. Commercially, it is natural growth of those Chinese companies when they become a global in size. When the Chinese market is the largest market in that segment, and there's other product outside want to have access to that market. So there is a supply chain restructuring synergy you can generate it, and there is a cross-selling opportunity to have access to developed market, as well as to having the advanced countries product to have access to China. That's the strength that we can bring to the table. I think those opportunities we've done several. And the others on the emerging market, only recently we look at other bigger markets like India, Southeast Asia. The business model innovation that happened in China in the last 10 years, or maybe even just 5 years, particular mobile internet and retail innovation, would have some, we sort of done something similar. It might have, we invested in Vietnam in mobile phone distribution and the electrical appliance store. We did the same thing in China. We did in Vietnam. We made money. So those type of things are commercially oriented, a very solid win-win situation, and we're mindful of a comparative advantage where we got in and how much we know. And I think in that sense, it's a friendly acquisition and merger, open up the China market, bring the access to the developed countries' product to the China market. I think that's part of the opportunity we will continue. I do think that's just a natural growth of the Chinese companies. We say, the joke is, you play a football game, a soccer game. If you only play on the backyard on your side, if you're not careful getting into your own gate, you have to go to the other side to have a full course play. So that's That's just natural.
And Michael?
Just in regard to One Belt, One Road, I think it's sometimes misconstrued into the size and scale of the opportunity as a group of investors with One Belt, One Road, because we're talking about 60 countries across multiple sectors. And the interesting element is going to be that the Chinese government have promised $800 billion over 5 years for the development of multiple projects. But the real success and what to watch for is around the Asian Development Bank, the Asian Infrastructure Investment Bank, which they really have the mandate of privatizing One Belt, One Road. So creating this entire idea into an investable asset class for the broader investor community. And the interesting part is, currently there isn't a shortage of capital. How often do we hear news reports of a new multi-billion-dollar fund has been raised, and the opportunities and how difficult it is sometimes to deploy that capital? And I think One Belt, One Road, for sitting as a group of investors, I think is a really compelling opportunity if the opportunity set can be matched with that capital, as you think about China from abroad and potential broader investing opportunities.
Jonathan, back to the analogy of the soccer team playing away. I mean, you go abroad quite often to look for investment. So what's your view?
Well, I think, let me answer this in two ways. I think, first of all, I'd like to talk about internationalization rather than just Belt and Road. And I think that we have found that the kind of companies that we're interested in investing in general, view the China opportunity as just, as you'd expect, enormously attractive. And I think I've yet to find a company in the hundreds of companies I've talked to that isn't willing to consider working with our organization and is not willing to consider taking out capital and is not willing to consider partnering with us. So I think that's one point. So in general, we find a very positive reception wherever we go. I think that in terms of our company, I think we're at a point where Ping An is at a really interesting point. We're almost entirely a Chinese company. We have a small office for a couple of our businesses here in Singapore for our Lufax business and for our One Connect enterprise services platform, both of which are at a very early stage. So we're in a mode where we're very interested in international opportunities. We want to find our way in the what is it, the Deng Xiaoping phase of that phrase of crossing the river by finding the stones one at a time. So we want to do it cautiously. We want to do it based on capabilities that we have. We're not interested in acquiring trophy assets for the sake of looking impressive to anybody. And frankly, we have such a tremendous growth opportunity in China that the benchmark for an overseas investment in terms of the attractiveness and the return is pretty high.
Interesting.
I may just give an example. Actually, my parents' company is CNB, China Merchant Bank. Actually, CNBI as a representative for CNB and making a strategic investment to DD. I know everyone knows DD, right? It's just like here. And why I said that's a good example is because when we make the investment to DD, we are looking forward to that payment cooperation with DD for CNB and DD. And also before we joined DD, actually Tencent joined the DD, and they just use the DD actually to deploy all the WeChat Pay something. Yeah, it's a financial cooperation, and both actually Tencent helps a lot in the technology part for DD because they actually generate a lot of the deals at maybe 1 second, the billions of deals there. It's very hard technology to do that. So DD when we investment, we got the high technology, and we got all those financial, inclusive finance or something. And after that, actually, maybe less than 1 year, DD make investment in Lyft, in the US Lyft, and also in Malaysia, the Grab. Then DD just refer us, whether you wanted to go with us to put money into Grab. That's the idea, that we put money in some good companies, and they generate enough capitals, and they generate I mean, enough capabilities, both technology parts and talent pool parts, they can put money in abroad, then we can go with them. That's the kind of idea of what we are thinking about.
Thank you for that. And we're almost out of time, but I do just want to conclude with a quick fire. Everyone giving me your view on this divergence we were talking about in our discussion backstage between public markets, the private equity space too, because today we're sitting in another day where the public equity markets are having a bit of a tough time. And I'm just curious as to why you think we are seeing that gap. Michael, maybe you want to pick up there.
I'm not sure I'm going to answer that in 15 seconds. But,
Sorry.
I'll give it a go. Yes, I think my comment backstage was I don't think I've ever seen such a divergence between the private market and the public market in terms of how people are approaching, particularly investments in tech, healthcare, consumer, because just the scale of the private capital that's currently out there, who are approaching investments in a very different way to the public markets. So you have companies that traditionally IPO'd a lot earlier, or when they were at a much more developed stage. But now what you're seeing is because companies are doing multiple rounds of financing, is companies are coming under pressure to list when they may not be ready to go through that process. And when they then have to go and work with public side investors who are managed on a quarterly basis or even on a shorter basis to manage pre-revenue or pre-earnings companies and to be able to hold those investments over a long period of time, is somewhat of a difference of approach, which has made this bifurcation, or divergence, sorry, is probably the better word, more telling. And I think what we're going to see through 2019, there is a big backlog of Chinese tech companies that still want to list, and it's going to be really interesting to see whether they're able to, and whether the public markets are able to stomach what we've seen is $50 billion of China tech issuance in 2018. Whether we can see that same level in 19 is going to be an interesting test over the next few months.
Dr. Wu?
I think if you are large investor, institutional investor, you should play both private and public. The reason of private have a long-term view, and we have more governance rights, we have more access to the management, we take a long view, which is always good. On the public side, because it's fragmented industrial structure, many leaders are already in the public side. The foreign participation is only 2 or 3%.
Right.
The retail, your counterpart is resale. The retail normally sell low and buy high. So is good for a sophisticated long-term investor. So I would say if you are institutional investors having capacity on both sides, do both.
There you go.
Yeah, actually, for CNBC, we are an asset management company, and PE just a part of that. I totally agree with Dr. Wu. We are actually doing both actively in public and in the private, just about the timing. Yeah.
So I think we're actually we're at a kind of a gap in time, and I think that those funds that invest in public markets generally aren't oriented towards the kind of long-term mentality and the kind of qualitative variables that you need to be able to track and understand deeply, and even the new models. I mean, just probably my closing point will be that in China, I think one of the unique things we're seeing is this new ecosystem economy emerging, and Sean just gave a really good example of Grab and Didi and Tencent, where one is a creator of organic traffic, and the other is a service that can be attached to that. And in that case, it actually works both ways because they both fit that criteria. We have many aspects in our. We've moved from being a product to a service to a technology to an ecosystem company, and those sources of organic traffic are just huge sources of future value. That's increasingly the model in the digital economy. Very few analysts really understand how to value that, especially public market analysts. So I think we're in this education phase and this transition, and I think we'll see more continuity between public and private over coming years.
Thank you. Thank you very much to all of you, Jonathan, Sean, Dr. Wu, Michael. We really appreciate your insights. And to any viewers who sent in questions, I'm really sorry, but we're stuck in the India panel question. So next session, we can figure out how to fix the iPad tech. But thank you all, and thank you to our panelists for bringing us those insights today.